American learned Dow theory the wrong way. Higher highs, higher lows. Draw some lines. Wait for the breakout. Buy. And then price reverses in your face. Again. Here's the problem. Someone taught you Dow theory as geometry. Draw a line, connect the dots, wait for the breakout. But that's not what Charles Dow actually observed 130 years ago. He wasn't drawing lines. He was reading psychology. Who's buying, who's selling, and why. That one distinction, geometry versus psychology, is the reason most traders fail with this theory. By the end of this video, you'll know how to read market structure, identify exactly where you are inside a trend, and know when a trend is actually reversing, using price alone. 3 pillars, 1 system. Let's go. Quick fact most traders don't know. Charles Dow never wrote a book on this. He wrote editorials for the Wall Street Journal in the late 1800s. After he died, 2 other writers, S.A. Nelson and William Hamilton, compiled his ideas into 6 principles. Those 6 principles became the foundation of technical analysis as we know it today. Pillar 1. The anatomy of a trend. Picture a beach. You see 3 things. The tide, slow, powerful, lasts for hours. The waves, rising and falling, but always following the tide. And the ripples on top of each wave, small, random, meaningless. Dow theory splits the market the same way. The primary trend, the tide. Months to years, the big picture. Read it on the weekly and daily chart. Higher highs and higher lows equals bullish. Lower highs and lower lows equals bearish. The secondary reaction, the wave, weeks to months. This is the pullback against the primary trend. It typically retraces 33% to 66% of the last impulse. This is where smart money reloads. The minor trend, the ripple, hours to days. Dow himself warned about this over 100 years ago. The minor trend is noise. And today, algorithmic trading amplifies that noise tenfold. Mistake number 1. If you're applying Dow theory on a 5-minute chart, you're not reading the market, you're reading noise. Anchor your analysis to the 4-hour, daily, and weekly charts. That's where real structure lives. Reading swings correctly. Everyone talks about higher highs and higher lows. Almost nobody talks about what actually makes a swing point valid. Dow theory cares about the close, not the wick. A valid swing high is a candle that closed higher, with candles before and after it closing lower. Same logic for swing lows. Why does this matter? Because wicks lie. A wick spiking above a level and closing back below isn't a new high. That's a liquidity sweep. A candle that closes above the previous high is a real structural shift. In an uptrend, each pullback holds above the prior swing low. The moment price closes below it, structure is broken. In a downtrend, each rally fails below the prior swing high. The moment price closes above it, structure is broken. Mistake number 2. Confusing internal structure with macro structure. Every chart has big, obvious primary swings and small internal pullbacks. Treat every dip as a structure break and you'll get whipsawed to death. Imagine a 3-week rally with 4 small 1-day pullbacks along the way. Those create 4 minor swing lows. But the primary swing low is way back at the bottom of the move. As long as price holds above that primary low, the trend is intact, no matter what the minor swings are doing. The rule: know which tier you're reading. Primary structure gives direction. Minor structure is noise. Pillar 2. The life cycle of a trend. Every major trend moves through 3 psychological phases. Know the phase, and you know whether to buy, hold, or get out. Phase 1. Accumulation. The market's been falling for months. News is terrible. Retail has given up completely. But quietly, institutions are buying. They can't buy it all at once. Their size is too big. So they buy gradually, absorbing retail's panic inside a tight range. On the chart, boring, sideways, low volume. Occasionally price dips below the range, stops get hit, panic spikes, and price snaps right back. That's not random. Institutions need sellers, and stop losses create sellers. Phase 2. Public participation. The main event. Supply dries up. Price breaks the range. Momentum kicks in. News turns positive. Trend followers pile in. On the chart, big candles, clean direction, expanding volume. This is the longest, strongest phase, and where money is made. Phase 3, distribution. News is euphoric. Every headline screams buy. Your Uber driver is talking about the trade. Everyone's in. That's exactly when smart money sells, because retail FOMO is supplying all the buyers they need. Price may still push to new highs, but the gains get smaller. Volume is high, but the move gets choppy. Something feels off, even though the news says everything's fine. Mistake number 3, the account killer. Buying in phase 3, thinking it's phase 2. The fix. Context. If the move's been running for months, news is euphoric, and everyone around you is buying, ask yourself if you're late. Mistake number 4. Accumulation and distribution look identical on a chart. Both are ranges. Both have fakeouts. Both sweep stops on both sides. The only difference is what came before. A range after a long downtrend is probably accumulation. A range after a long uptrend is probably distribution. One more thing. Phase transitions aren't always clean. A breakout from accumulation can fail once, retest the range, and break out again later. And you often only recognize a shift into distribution after it's happened. That's why context beats precision. You don't need the exact phase. You need to know if you're early, on time, or late. The rule: trade phase 2. Be patient in phase 1. Be careful in phase 3. Volume confirmation. Dow Theory has a rule most traders either ignore or misuse. Volume must confirm the trend. In a healthy uptrend, volume expands on the impulse up and contracts on the pullback. That tells you the buying pressure is real and the pullback is just a pause. When it's reversed, volume shrinking on the impulse, expanding on the pullback, that's a warning. The trend is running out of fuel. Practical problem. If you trade Forex or crypto, there's no centralized volume data. Forex tick volume is a rough proxy at best, and crypto exchange volume is often inflated. The rule for decentralized markets: use volume as confirmation, never as a trigger. If structure, phase, and context all line up, low volume on a pullback is a good sign, but don't enter a trade just because volume spiked. Mistake number 5. Either ignoring volume completely or over-relying on it in markets where the data isn't reliable. Volume is a supporting character. Price leads. Volume confirms. Pillar 3. When a trend dies. This is the question that separates profitable traders from everyone else. Dow's 6th principle. A trend persists until there's clear evidence of reversal. But what actually counts as evidence? In an uptrend, the trend is alive as long as price keeps making higher swing lows. It's dead when price closes below the most recent significant swing low, and how that close happens matters enormously. There are 3 scenarios when price touches a prior swing low. Scenario 1. Price wicks below, then closes back above. That's not a break. That's a liquidity sweep. Institutions triggering stops to fill orders. The close held. Structure is intact. Scenario 2. Price closes below, but the very next candle reverses immediately. Suspicious. Wait. Scenario 3. Price closes below with a strong, full-bodied candle and minimal wick, and the next candle confirms by continuing lower. That's a genuine structure break. That's your clear evidence. Mistake number 6, the deadliest one. Confusing a liquidity sweep for a reversal. Price dips below a key low, you panic sell, and it shoots back up without you. Institutions push price below support specifically to trigger your stop and fill their buy orders. This is what modern traders call a market structure shift. Dow described the exact concept over a century ago. Today's frameworks just gave it a name. One more check before you act on any break. Which time frame did it happen on? If a swing low broke on the 1 hour, but the daily lows are still intact, the primary trend hasn't changed. That's minor noise, not a real reversal. The rule: Never act on a wick. Wait for the close. Wait for follow-through. Confirm it on the primary time frame. A real break has displacement. A strong candle that doesn't look back. No displacement, no break. Warning signs before the death. Before a trend dies, it weakens, and that weakness leaves fingerprints. Warning sign 1. Diminishing impulse legs. Compare 3 consecutive pushes in trend direction. First one's long and powerful, second is shorter, third barely moves. Like a runner whose strides are shrinking right before they stop. Warning sign 2. Deeper corrections. In a healthy trend, pullbacks stay shallow, around 30%, not even reaching the midpoint. When corrections start hitting 50%, then 60%, then 70%, buyers aren't showing up as strongly. Control is shifting. Warning sign 3. Failed breakouts. Price pushes above the prior high, then immediately reverses. No follow-through, no displacement. Just a spike and a rejection. Often the final warning before a real reversal. Important. These signs don't mean reverse your position. They mean tighten your stop, reduce size, and stop adding to winners. Mistake number 7. Treating weakness as if it's already a reversal. Weakening trends can stay alive a long time. Only trade the reversal when structure actually breaks. The 5-step framework. Everything above compressed into a system you can use tomorrow. Step 1. Define the primary trend. Open the weekly or daily chart. Higher highs/higher lows equals bullish bias, longs only. Lower highs/lower lows equals bearish bias, shorts only. This step alone kills half your bad trades. You stop fighting the primary trend. Step 2. Identify the phase. Tight range after a long decline implies probably accumulation. Be patient. Strong directional candles, expanding volume leads to participation. This is where you trade. Months-long move, euphoric news, everyone's in leads to probably distribution. Be careful. Step 3. Wait for the secondary reaction. Don't chase the impulse. Wait for the pullback. 33% to 66% of the prior move. On Fibonacci, that's your 0.382 to 0.618 zone. This is where institutions reload and where your risk to reward is best. Step 4. Confirm with context. Does volume support the trend? Are closes holding? Is primary structure intact? If yes to all 3, you have alignment. If any fail, wait. Step 5. Execute. Enter in the direction of the primary trend during the secondary reaction in phase 2. Stop below the most recent swing low. Trail it as new swing lows form. Exit when structure breaks. A swing low violated with a close and displacement. Define, identify, wait, confirm, execute. Close. 3 pillars. The anatomy. How to read structure properly. 3 tiers. Valid swings, closes over wicks, primary structure is all that matters. The life cycle. Accumulation, participation, distribution. Where smart money buys, where the trend runs, where it ends. The death. Real breaks versus liquidity sweeps, displacement as proof, and the warning signs a trend is fading. 1 5-step framework tying it together. Dow Theory was never about drawing lines. It's about reading who's buying, who's selling, and why. You now have the tools to actually do that. A 130-year-old theory, sharper today than ever. If this changed how you see Dow Theory, subscribe and hit the bell. The next video isn't more theory. I'm taking this entire framework live on a chart, from a blank screen to a complete trade plan, using these exact 5 steps. Drop a comment. Which of these 7 mistakes have you made?